Assalamu alaikum friends, welcome to today's standard. Today's standard is IAS 21, one of a very important standard. So you can expect this standard most of the time in your exam. Foreign currency in individual financial statements. For example, you have bought a foreign subsidiary or you have disposed of foreign subsidiary, right? Or an associate, which is foreign. You need to know how to deal with that. Okay? You need to know which rates to convert. And this IAS 21 it mostly comes in conjunction with your group accounting, okay, in your question number 1. So that's why this chapter is equally very important if you're attempting group accounting. Sometimes it comes, sometimes it might not come in group accounting, but it might come in other standard, in other questions. Okay, so let us see the what are we going to cover in IAS 21. Foreign currency, then we are going to see IAS 21. We are going to go in depth in IAS 21. We have to know what is functional and presentation currencies. How to determine whether it's a functional, what is a functional and what is a presentation currency. This question is very common. 95% of the time this question has been asked. Even in my SBR paper I was asked. The first question in fact is IS 21, right? Functional and presentation currency. Then we have accounting for individual transactions in a foreign currency. Okay, and most of this what you're going to study in IS 21 is covered in financial reporting. But here it will be tested in more complicated scenarios. Mostly how to determine an entity's functional currency. Okay, this is like a common question. If I have to pick a most common question in this standard will be how to determine a company's functional currency, and this comes in a group accounting. So IS 21 deals in these three things. What is it? First, it defines what is functional and presentation currency. Definition of functional and presentation currencies. We'll start with this. Next, accounting for individual transactions in a foreign currency. How do you deal with individual transactions in a foreign currency? Then we have to translate the financial statements of a foreign operation. This is what you need to do in group accounting. What happens in the group accounting, if you have seen my question 1 to 16 of the Kaplan revision guide, because they are in group accounting, you must have went through this, that there are some portion of it which is relating to IS 21, some questions where you might have one local subsidiary and one foreign subsidiary and you need to consolidate. So when you consolidate, remember it needs to be consolidated in the parent's presentation currency, but the subsidiary's currency might be something else. Okay, so you have to translate the subsidiary's financial statements to the groups, that is the parent's financial statements, their currency. You will definitely be given the rates, but you have to know which item is for which item you need to use which rate. Trust me, IS 21 is again one of the easiest standard. If I have to say, if I have to pick some standards, few standards are very easy, few standards are at a moderate level, few standards are tough. Okay, they are a little bit challenging, but IS 21, like how IS 7 statement of cash flows, IS 21 is also pretty easy. It's very straightforward. It's very hard to complicate questions from this area. Trust me, IS 21 is one of the easiest standard to score marks. Okay, next. So they have told that translating the financial statements of foreign operations covered in a later chapter. That means not in this chapter. Okay, starting with functional and presentation currencies. Okay, what is functional currency? Definition, you have to memorize it. Okay, so a functional currency is the currency of the primary economic environment where the entity operates. Okay, for example, you are operating in US, your functional currency will be US dollar, primarily where you are operating. Okay, that is your functional currency. Next, these are some of the factors, okay, which you need to know. If you can memorize these points, even better, because these are exactly the same points that you have to write in the exam. If they give how to determine functional currency, definitely this question is always asked, how to determine functional currency. These are known as primary factor to decide whether they are functional currency or not. In the exam, okay, this is how your exam scenario is. 2-3 currencies they will give you, sometimes 2 currencies, sometimes 3, sometimes 4. out of this four, you have to determine which one is a functional currency. To determine them, there are two sets of factor that you need to study. One is known as primary factor, the other one is known as secondary factor. First, we go through this test. We go through the four primary factors. If that currency does not satisfy any of the primary factor, that meaning to say that they are not functional currency using these four primary methods, then you look out the other two secondary factor. Okay. So what is the first primary factor to decide whether it's a functional currency or not? The currency that mainly influences sale price for goods and services. It should mainly influence sales price for goods and services, whichever currency it is. For example, they will write that this currency is in US dollar. Mostly 40% of the sales are in this dollar, or 60%. So they will give you percentages. They will give you that thing to show that mainly it is in which currency, the sales price. Next, we have the currency of the country whose competitive forces and regulations mainly determine the sales price of goods and services. So their competitive forces and regulations determine the sales price of goods and services. Next, the currency that mainly influences labor, material, and other cost of providing goods and services. So they will give you the in which currencies are your cost, labor cost, material cost, other cost. They will see. So it's revenue, your sales price minus the cost. Sorry, not minus the cost. Sales revenue and cost. Which currency are they in? Sometimes it's possible that your revenue is in one currency, cost is another currency. Sometimes they are both in one currency, both are in the same currency. Then in that case, it's easy for you to determine to say that this is the functional currency, because majority of your sales are in that currency, even the costs are in that currency. You understanding? So here, this is relating to cost. Okay, you need to remember these points, because there are no other points from nowhere. These are the only points that you need to write, known as primary factor. Next, if the primary factors are inclusive, then the following secondary factors should also be considered. Okay, so you should consider this too. What is it? The currency in which, so if you cannot decide from the primary factor, sometimes it's very easy to decide, but not all the time. That time, secondary factor. What is it? The currency in which funds from financing activities are generated. You have to see funds from financing activities generated in which currency. You're taking definitely some funds, loans or something to finance your activity. That is in which currency? That you have to see. Next, currency in which receipts from operating activities are retained. So you have to see the receipts from operating activities in which currency. Okay, this two are known as secondary factor. This area is must. This portion is must under IAS 21. Your IAS 21 is built after this only, primary and secondary factor. This primary and secondary factor, again I'm repeating, are used to determine functional currency. Don't get confused with presentation currency. Presentation currency can be in any other currency. It could be in any currency. We don't have things to determine what is presentation currency. These factors are only applicable to determine functional currency, not presentation currency. Presentation currency is your choice. You can present in any way. Okay? So there are times when a foreign subsidiary, rather than applying the above rule, should simply use the same functional currency as its parent. What does it mean? This 4 points also you have to know. When the parent and the subsidiary should use the same functional currency. Like the subsidiary should adopt what parents are using as functional currency. Okay? What is it? The foreign subsidiary. So they should use same functional currency as this parent. In determining this, IAS 21 says that the following factors should be considered. These factors you have to know, because these factors you have to write in your answer. What is the 4 factors? Number 1. It's not that all the time you have to write all the 4 factors. No. It's not like that. You have to see in the case study which factor they are talking about. Are they talking about the level of transactions with the parent? Are they talking about that volume and frequency? Then you mention this point. Are they talking about this point, the first one? So you have to see which point is applicable, and in the case study you have information for which point out of this 4. Accordingly you will answer. So whether Number one, whether the foreign operation operates as an extension of the parent rather than having significant autonomy. Okay, so if the foreign operation extension of the parent rather than having significant autonomy, that means the foreign operation, they do not have any autonomy, they do not have any freedom. It is the parent's extension. Parent is the one who's controlling. They have the autonomy over the subsidiary, foreign subsidiary. In that case, foreign subsidiary is no different from parent. They have to use the same functional currency as the parent. Second, the level of transactions with the parent. The volume. Definitely in the exam, if they give you something volume and all, you can write those points. Level of transactions with the parent. If it is it too much? Is it very frequent? If it's very frequent, then parent's functional currency only they have to adopt. Whether cash flows are readily available for remittance to its parent, are they remitting it to parents? If so, then is the parent's functional currency. Fourth, whether the foreign operation has sufficient cash flow to service its debts without needing the funds from its parent. Okay, whether the foreign operation has sufficient cash flow to service its debt. If they do not have the cash flow to service its debt, okay, if that means they're dependent on the parents. So parents' functional currency only they have to use. If they need funds from parent, it's the parents' functional currency. Okay. It's like if an example I have to give, it's like you and your parent. Okay, your parent is investing in your education and all, right? So you're controlled by them, right? You're dependent on them for your finance, for your tuition fees, for your school fees, all this. So you are under them. Okay, you're no separate from them. So it's like that. Okay, parent and subsidiary. So whatever parents say, they have to listen. Their functional currency only they have to adopt. So same, because they're dependent. That dependency relationship is there. If they had the autonomy, if the level of transactions was very low with the parent, okay, if they don't remit it to the parent, okay, then you can say okay, it is the subsidiary. They are independent of the parent, therefore they have their right to choose their functional currency. So the fees and all your parents are giving for your school fees, you cannot say this is my fees. It's your parents' fees only, right? Even though you are the one who's actually going and giving it physically, the cash and all or the credit, it's not yours. That money is your parents. So you have to go by the rules what your parents tell. Same way for the company also, because they are controlled under the parent. If you are independent, if you have been earning separately, then you are not no more controlled by your parent. You can do anything you wish with those money. You are independent. Okay. So go through this factors, revise it. Now let us move on towards the presentation currency. Most things are about functional currency, then the presentation currency. Presentation currency, not much is there, but it is defined in which entity presents its financial statements. Okay, in which currency does the entity present its financial statement? For example, I decided that I will present my financial statements in US dollar, then that US dollar is my presentation currency. Your presentation currency could be different from your functional currency, remember. Okay, they might not be same all the time. Sometimes they might be, but sometimes they might not be. So they can be different from functional currency. This you need to remember. Test your understanding will be done later. Now let us go to the second thing. Accounting for transactions designated in a foreign currency. If something is in a foreign currency, how do you account for the transactions? So where an entity enters into a transaction denominated in a currency other than its functional currency, that transaction must be translated into the functional currency before it is recorded. You understanding what does it mean? That means in the financial statements, you can only put the functional currency, no any other currency. If your functional currency is something else, okay, and the transaction happened in some other currency, remember to translate that transaction into your functional currency before you put it in the financial statements. That's what this line means. Okay, so the exchange rate used to initially record transaction should either be What are the two rates? One is spot exchange on the day the transaction occurred. Okay, so you will definitely use the exchange rate on that date, on the date of the transaction, or an average rate over a period of time, providing the exchange rate has not fluctuated significantly. So you might be even given sometimes average rate also. That also you can use, or you might be given the spot exchange rate. Depend accordingly you can use. Okay, you need to convert this. So that initial transactions, how do you convert? Either you can use that day's exchange rate when the transaction happened, or average rate. Okay, but average rate you should use when you can see that your exchange rates are not fluctuating too much. Okay, that time average rate is safe. Let us go to the cash settlement. So when cash settlement occurs, such as when cash is received from an overseas credit customer, the settled amount should be translated into the functional currency using the spot exchange rate on the settlement date. Whenever you receive that money from your foreign creditor, you have to translate that into functional currency using on that settlement date what is the exchange rate. Okay, so the cash you are receiving or paying needs to be translated into functional currency. So if this amount differs from that used when the transaction occurred, there will be an exchange difference. Okay, so your transaction occurred that day, it was something else. Now when you're converting, okay, to functional currency on the settlement day, the amount is different, so that difference is known as exchange difference. Okay, definitely you will get an exchange difference, there is no doubt about it. Every question which will be given to you in the exam will have an exchange difference if IAS 21 comes. IAS 21 does not always come. When, how do you know that you have to apply IAS 21? They will mention foreign subsidiary, they will mention different currencies. So it is understood that you have to apply IAS 21. Now, exchange differences on settlement. Where does this exchange difference is recorded? You have to know the place also. Okay. So requires that exchange gain or losses. It could be gain, it could be losses. We don't know. On the settlement of individual transactions are recognized in P&L and the premium is arise. It is recognized in P&L. Very simple, right? Gain and losses are recognized in the profit and loss account only. So initially you recognize there. This is for individual transactions. IAS 21 is not definitive in stating where in profit and loss any such gain or losses are classified. They didn't say that. They just told profit and loss. That's it. So it would seem reasonable to regard them as an items of operating expense or income. Okay. So because they didn't classify exactly under where, you can classify them as operating expense of or income also. However, other profit or loss headings may also be appropriate. You can even use other profit or loss headings. For example, you can write exchange gain or exchange loss as a separate heading and write, right? Because there might be more than one transaction. It's not only from one transaction you having gain or loss. You might have thousands of transactions. Okay. Now let us go to this example. How to settle the exchange differences, because this is the key. The key thing is you should know how to account for exchange differences. This is what will be asked in group accounting also. This is much easier, of course. In group accounting, it's little more work is required. You can see my question 1 to 16 of Kaplan revision kit. I have solved all those questions. It's there. It's uploaded on my playlist. Revision kits, SBR revision kit solutions. Okay, it's out there. So go and check it out. And today only, after finishing the standard, please go and practice the questions only if IAS 21 is there. Group accounting questions, I would suggest, because this is the fastest way to learn anything. The day you go through the standard, that day only you pick up questions and you start doing it. On 7th May, an entity with a functional currency of dollar. So what is the functional currency? It was dollar. Sold goods to German entity for 48,000 euro. Okay. On this day, the exchange was given. The sale is translated into functional currency in the exchange rate on the transaction date. Okay. So how are you going to translate the transaction? Whatever the currency is at that date. So it was 3.2. So you divide this 48,000 by 3.2. That is receivable 15,000. Debit receivable credit revenue. Okay. So customer paid the outstanding balance. On this date, rate of exchange became 3.17. So the settlement is translated into the functional currency using the exchange rate in the place on the settlement date. On this date, whatever the price is, the balance you have to translate using this rate, not the beginning one. Okay, so that will be 48,000 divided by this 48,000 divided by this 3.17. Okay, even though the goods was sold on that day 7th May 2006, and later they are paying the outstanding balance 20th June 2006, so you have to use this exchange rate, okay, to convert. So this will be your cash, debit cash, because you are receiving cash. So from your receivable it will be credited 15,000. Why? Just see your receivable account, it's debit here 15,000, right? So your receivable balance at the end should be zero only. That means whatever receivable you have in the beginning and the end, it should be zero. There should be no receivable, because customer paid the outstanding balance. So your receivable here it's debited, here it will be credited. Fully it's gone now. You have paid the outstanding balance, it's over. So you can see there's a difference between the debit and the credit side. 142. Your receivable is 15,000. But you received cash more because of that exchange rate differences. You are in cash, you are receiving more, but your original amount was 15,000. So that is a exchange gain. 142, the difference. Okay, so it will be credited in the profit and loss account. Okay, because exchange gain credit and exchange loss debit. So the 142 exchange gain forms part of the profit for the year. Right? I think it's very simple. Anyone can understand this. Now coming to the year-end balances treatment. So the year-end balances definitely goes in your statement of financial position. How do you treat those balances? Overseas items, okay, remaining in the statement of financial position at the year end depends on whether they are monetary or non-monetary. These two things only you have to see. That means all your statement of financial positions items, okay, how do you translate them using which rate? Because remember, every item has some rules. You are not using one rate only to translate everything. So first you see whether it's a monetary item or a non-monetary item. Let us go through monetary items first, okay, in the first branch. So units of currency held and assets and liabilities will receive or paid in a fixed or determined number of units of currency. For example, they have given cash. Cash definitely is a monetary item. Receivable because you are receiving money from your debtors. So monetary. Payable also, loan also. This is a monetary item. Okay. You are going to receive or you have to pay some fixed currency. So that they are known as monetary items. Which exchange rate you use? Retranslate using the closing year end exchange rate. So you always use year end exchange rate only. Okay, it's fixed. It's always year end exchange rate for monetary items, whether it's cash, receivable, payable, loan. Now let us go to the non-monetary item section. Other items in the statement of financial position, what are they? Such, for example, non-current assets, your inventory, your investments. Okay, so what do you do for this? Do not retranslate. See, here you are retranslating using closing rate, but here you do not even translate also. Okay, retranslate. If an item is carried at fair value, the fair value should be translated on the date it was determined. So whenever you have determined that fair value, on that day only it has to be translated. Okay, if an item is carried at fair value for all the non-monetary items. So this table here, make sure that you go through this table. Okay, now let us go through this. Exchange differences on retranslation of monetary item. Now they are only dealing with monetary items. That exchange differences which are for monetary items only, where does it go? As with exchange differences arising on settlement, IAS 21 requires that exchange differences retaining or arising on the retranslation. Why do you retranslate? Because definitely these are closing balances. Remember, opening balances you have translated using some opening rate. Closing you will again retranslate using closing rate. So there will be some differences. Okay. Retranslation of monetary assets and liability must recognize. This is also recognized in profit and loss account. It's very simple to understand. Exchange differences, profit and loss account for monetary. So IAS 21 does not specify the headings under which such gain or losses should be classified. It would seem reasonable to provide them as items operating same. What has been given for individual transactions, even for this also, monetary assets and liabilities, same thing. It is recorded on profit and loss account. So now let us see an example for that. So this is the same example. Okay, here they have translated the receivable into 3.2 and this is the receivable. By the reporting date, invoice had not been settled. The rate of exchange was 1:3.4. So now You have to understand how to deal with it. Receivables are what? Receivables are monetary items. You have to use the closing year. Okay. So what is the closing? It is 3.4. And this will be this one. Okay. So if you see here, the difference, okay, it was 15,000, but it went down to 14,118, which is 882. This time it's an exchange loss. So it will be debited in profit and loss, credit in receivable, 882. Okay. The difference only. Because before it was 15,000, now it is 14,118, the closing balance. That means your receivable went down. That's why receivable is credit. It's an exchange loss. You can see year end is 14,118. So it's an exchange loss. Okay. Now let us go to the non-monetary items. Non-monetary items, we do not retranslate. Okay. So they have a functional presentation concept dollar. That means functional presentation both are dollar. Accounts for IAS 16, that means property, plant and equipment using cost model. And Olympic purchase of plot of land in another 1.2 million dinar. So they are using cost model for the land, and this one for the land they have purchased. They have given the exchange rates. Okay, so the land is initially recognized at what? At cost. Initially. This should be translated in the functional currency using the exchange rate on the purchase date. The land is therefore initially recorded. So initially, when did you purchase the land? 1st July 2005. It was this rate, 4. Here you are not taking the closing rate how we took for monetary item. This is non-monetary. So you take at the date when transaction has occurred. So 1.2 divided by 4. Okay, it will be initially recorded as 300,000. Next, land is not a monetary item, so it is therefore not retranslated. Even in the exam also, you need to write this such things that it will not be retranslated because it is not a monetary item. So in accordance with IAS 16, no depreciation is charged. This means that land remains at 300,000 only. Okay, because land, we don't depreciate land, right? So 300,000. Now let us go to the non-monetary items at fair value. Okay, so it is the same question only, but here the fair value was 1.5. Okay, at the end they have added this one line. Now, so initially land is recognized at cost as before, even with cost, even with fair value. This should be translated in the functional currency using the exchange on the purchase date. Okay, so it's 300,000 only because you have purchased at that date. But later this part will change, because land is not monetary, so it's not retranslated. Now we are using the revaluation model in IAS 16. So fair value has been determined. This valuation is in dinar and so must be translated in the function currency using the exchange rate in place when the fair value was determined. When was the fair value was determined? At the end. So land must be revalued to 1.5 divided by 3, which is 500,000. So you can see there's an increasement from 300 to 500 carrying value of the land, right? Where will this carrying amount of the increasing carrying amount of the land be recorded? It is recorded in this place. Revaluation gain in other comprehensive income for the year. Remember, revaluation gain, if you're using fair value model under IAS 16, any revaluation gain goes into OCI. That you should know, okay? And the revaluation reserve will be included with another components of equity. So revaluation reserve, it is taken as other components of equity in the statement of financial position at the reporting date. Okay? You should know the impact in both the places, statement of profit and loss and other comprehensive income as well as statement of financial position. Okay? Then we have test understanding 2. Definitely we'll solve this at the end. Test understanding 3 we have. Then we have some criticisms of IAS 21. What are they? Every standard has some problems, some issues, some criticism. Make sure that you know some. Okay? Not in detail, but you should know briefly what are the criticisms. One is lack of theoretical underpinning. What does it mean? It is not clear why foreign exchange gain and losses on monetary items are recorded in profit and loss, and yet foreign exchange gain and losses arising on consolidation of a foreign operation are reported under OCI. You see, for individual transaction, it is profit and loss, but when it comes to consolidation of a foreign operation, gain and losses are reported in OCI. It's not clear, right? Why it's in one place and why for this it's in one place. So it is argued that recording foreign exchange gain or losses on monetary items in profit or loss increase the volatility of the reported profit. Because you are recognizing it in profit and loss, the monetary items gain and loss, it increases the volatility of reported profits. So it has been suggested that the foreign exchange gain or loss should be recorded in OCI if there is a high chance of reversal. High chance of reversal means you can change it to profit and loss account later. If there are high chances of doing it, record it in OCI. Now let us go to the long-term items. Okay. It is argued that retranslating long-term monetary items using the closing rate does not reflect the economic substance. Okay. This is because the current exchange is being used to translate amounts that will be repaid in the future. Exactly. Do you think closing rate reflects the actual thing, the economic substance? No, because you are translating using closing exchange rate. That means current exchange rate. Okay. But that will be repaid in the future. In the future, exchange rate will change, right? But today you are translating the amount using the today's current exchange rate, but you will pay in future. So in the future, the amount will change. Foreign exchange gain or losses on long terms are highly likely to reverse prior to repayment and receipt, right? That means even foreign exchange gain or loss, you might say, okay, recognize it under OCI, but they can be recorded under profit and loss account later. They can be reversed, right? Depending on payment and receipt, suggesting that gain and losses are unrealized. This provides further weight to the argument that foreign exchange gain and losses on at least some monetary items should be recognized in OCI. Okay. So maybe the receipt or the repayment you have to do regarding for liability or you're receiving something. You will be receiving it in the future, right? Long term. So that's why that gain and losses, the foreign exchange gain and losses are actually not realized. They are unrealized. Understanding? So that means they are giving more attention. They are telling that it's better to provide under OCI. At least on some monetary items. Okay? Because monetary items we told it's recorded in the profit and loss account. But they are saying better to provide at least some of them under OCI. Now let us go to the average rate. You have an average rate also. Average rate we use for the profit and loss accounts income for items. For example, income and expenses. All your sales, all your cost in the profit and loss account are translated using average rate only. So IAS 21 does not stipulate how to determine the average exchange rate in the reporting. They do not tell you how to determine the average rate. They will give you the average rate, so don't worry about it. Average rate will be given to you. This increases the potential for entities to manipulate their net assets or total comprehensive income. Because IAS 21 does not say how that average rate has been calculated. Remember, they just give you one figure. But how did you actually get that figure? Right? So there are chances that your net assets or total comprehensive income can be manipulated. Right? Because you're using average rate to translate. So the use of different average rates will limit comparability between reporting entities. Yes, if one company is using different average rate, the other one is using the other one, it's very difficult to compare. Non-monetary versus monetary. Okay, so the distinction, which is what is monetary and what is non-monetary, can be quite tough, right? It would benefit from further clarification. That means IAS 21 needs to give some more further clarification, but they still didn't give. Remember this. These are issues. Okay. Next, foreign operations. So IAS 21 uses a restrictive definition of a foreign operation. What is that definition of foreign operation? A subsidiary. It could be a subsidiary also in the foreign. It could be an associate also. It could be a joint venture also. A branch also whose activities are based in a country or currency other than that of the reporting entity. That means it is not your country, something outside your country. The currency. Even the currency is different to you, the country is different to you. So it is argued that IAS 21 should instead use a definition of foreign operation that is based on a substance rather than the legal form. Okay, rather than saying that where it is located, legal form, that this is a foreign operation, they should rather give preference over to their substance. Right? So that's it for this one. Let us go through this chapter summary before I actually finish test to understanding. So we studied the effects of IAS 21. Then we went to functional versus presentation. Functional is The primary economic environment where the entity operates. Okay, the concept of that. Presentation in which entity presents its financial statements. Then we have accounting for individual transactions at transaction date, on settlement and reporting date. Okay, so that's it, and let us now start with test understanding 1 and complete all test understanding. So that's it for IAS 21. We have successfully completed IAS 21. Chive is an entity located in a country whose currency is dollar. Okay, so his currency is in what? It's in dollar. 70% of Chive sales are denominated in dollars. 70%, okay, is in dollars. The sales, okay, and 30% of them are denominated in sterling. Chive does not convert receipts from customers into other currencies. Chive buys most of its inventories and pays for a large proportion of operating costs in sterling. Okay, operating costs are in sterling and buys inventories also. Chive has 2 bank loans outstanding. Both of these loans are denominated in dollars. Okay, what is the functional currency of Chive? This is exactly the same way a question can be asked from you, SBR exam, if you have gone through the revision kit by now. So you answer this by using IAS 21, the factors, right? We are going through the factor now to answer this. So here is the answer. So firstly, we go by the primary indicators of functional currency that should be applied. Most of Chive sales are denominated in what currency? Dollar. And so this would suggest that dollar is a functional currency, right? Looking at the sales, because it is in dollar. But since a lot of the cost of the business are denominated in sterling, it could be argued that functional currency is sterling. You can see this is like a 50-50. It's very hard to decide because sales is in one currency, majority of it is in dollar, but versus the cost is in one currency, in sterling. Okay, what should we do? So since the primary indicators of the functional currency are not clear cut, it is important to look at the secondary indicators. Receipts are retained in which currency? Both dollar and sterling. Again confusing. Now you go to the other factor. However, funding is generated in the form of dollar, but funding is in dollar because they have told that 2 loans they have taken both are in dollar, which suggests that dollar might be Chive's functional currency. So 3 uh, paragraphs you need. One, you are discussing the primary factor. Second, you are discussing the secondary factor. Third, you are discussing the conclusion. So based on the things what you have gone through or all the things considered, it would seem that functional currency of Chive is dollar. This means that any business transactions that are denominated in sterling must be translated into dollar in order to record them, right? Everything needs to be, at the end, has to be presented or translated in dollars only. Okay, because you see the cost, the sales is in dollar, even the finance, the loans also they have taken in dollar, but only the cost is in sterling. So more factors are towards dollar. This is how you write your, this is how you decide. You see in which currency more factors are for. Is it more for the sterling or the dollar, or is it more for the dollar versus the sterling? Okay, in this case it is towards dollar because your finance, the 2 loans you have taken in dollar, also your sales is in dollar, only the cost is in sterling. Now let us go to the second test understanding. So this is about 3 company, okay, A, B and C, butler, waiter and attendant. Okay, wow, what a combination. An entity butler has a reporting date of 31st December and a functional currency of dollar. On 27 November 2006, Butler PLC buys goods from Swedish supplier of this much. On 19th December 2006, they pay the Swedish supplier in full. So when they buy the goods, it is on credit, that is on some other date. When they actually pay, that is on some other date. Okay, 2 rates for 2 different days. Now how are you going to record the above transactions for the year ended 31st December 2006? All this happened before 31st December 2006. So first we'll answer A and then we'll go to part B. Okay, so definitely you need to when you are recording your payables, okay, and your purchases, you are recording using 11.15, but cash receipt and all, when you have to convert, you will be translating using 10.93. Understanding? So the transactions on 27 December must be translated using the exchange rate on the transaction date on 27 November 2006. That will be, that means purchases and payables. So purchase debit, payables are credit, right? You take 11.15. Next, cash settlement is on some other date. So that will be settled, exchanged using the 19 December 2006 rate, which is 10.93. So again, you are converting 324,000 by 10.93. You are getting a different rate, okay? So what do you do? What do you do? So you see, you start with the debit side, okay? What are you going to debit? What are you going to credit? You are receiving cash. So you can finish the cash part because you are receiving cash. Cash is easy, this amount only in full. But you need to debit your payables. See, your payables here was credited. Now you need to debit because you are paying in full. So this amount only, up to this amount only is your debit payable. So only that amount only you will debit. It was credit before, now it's debit. Okay, that means it's fully gone. No payable anymore because you have paid the cash in full. So it's no more payables will be there. So the balance is, it could be profit, it could be loss. Okay, definitely you are receiving cash, right? Sorry, this is credit cash. I'm sorry, not receiving cash. You have to pay cash. So you're paying cash more than your payable at the settlement date. So it's a loss. Definitely, this is a loss which needs to be debited. 585. Okay, so it's known as an exchange loss, and this will be recorded in P&L. Now let us go to the part B, the second one, waiter. So an entity as a waiter has a reporting date, and the dollars function currency. Waiter borrows in the foreign currency, and the loan was 120 taken off. So this is a loan of 120, and repayment is this one. Repayment is not made on full. Okay, and you have been given 3 exchange rate this time. Okay, so on 31st December 2007, what will be the rate? This is a loan. Remember, loan is what? It is a monetary asset. Monetary asset. So you have taken the loan on 1st Jan, that's 2. And then repayment is on 1, that is 3. Okay, but since this is a monetary, you have to use closing rate. Let us see. So here, money was brought and this must be translated at the exchange rate. That means it's 2. Okay, so that means you have taken a loan. So because you have taken a loan, you will receive cash, debit, cash, credit, loan. It's easy. On the settlement date, remember, most of the students have problem with the settlement date only. That day, what is debited, what is credited. But here it's not full settlement. Only partially they have settled. Okay. On the settlement date only, they will settle when they have received the cash. Okay. That is 3. That is 3 they are taking. Okay. So here, that means your loan amount will reduce by that amount, 120,000. So how to reduce loan amount? You cannot say increase, reduce. This is credit loans. Okay. So you need to debit loans by this amount, 120,000. That means from 240 it will be reduced to 120,000 because you are paying some of it in cash, so your loans will go down. And credit cash because you are paying in cash. So from your cash account, 240,000 it's debit. It will reduce and it will become 120,000. Then we are going to the third part, the reporting date, which is at the year end. This is not the year end. This is the cash settlement date is different. When your cash settlement is before the year end, you need the third adjustment. To decide that, you need this definition, whether it's a monetary or a non-monetary. So loans are a monetary liability at the reporting date. The remaining loan, what is the amount of remaining loan? Okay, we'll go to the question, back to the question. So the loan was for 120, repayment is 40, the balance 80,000. What about that 80,000 which you didn't pay? Okay, so that 80,000 you have to translate at the year end exchange rate. Okay, the year end exchange rate is 3.5. This gives a closing liability of 280,000. That closing liability you need to calculate when you have loans not fully settled. You definitely will have a closing balance. In the before one, part A, we didn't have any closing liability because loans we paid in full. It's zero. Whatever you debited, you credited. Here we have a closing liability, right? Now we are going to the exchange loss. Okay, here they have decided because they have calculated. We'll see. You need to retranslate. Okay, so first it's 120. You take 2 and you got 240. Everything whatever you have done, you are putting this in the table format. Remember this. This format will help you a lot in the exam. This is the way you need to do to calculate an exchange gain or a loss. Remember, exchange loss or a gain is always the balancing figure. So don't ask me from where we got it. Okay, you start with the opening, take 2, multiply by 2 and 240, then 40 you have paid. So at the end it's 80,000 and this you will use 3.5 to convert, which is to 80,000. Okay, so when you take 240 minus 120, it is 120 here, right? But at the end you had 280,000. That means it's a loss because remember this is a loan. If your closing balance is more than what should be, it's a loss. Exchange loss. Okay. So it's a loss. 160,000 is the exchange loss. You understanding? So now how to write the double entry to record this loss? Remember, when you get a loss or a gain, you should know the double entry. You should in fact know the double entry for everything in SBR. Okay. Maybe for everything they might not give you double entry because they assume through your financial reporting you know the double entry. Okay, so not for everything they will give you double recording in your textbook, but definitely you should know what is debited, what is credited. So definitely since it's a loss, so your profit and loss is debit by 160,000 and credit loan because loan amount will go down. I'm sorry, it will go up. It's credit loan, yeah. So 160,000. Exchange loss will be added to that loan amount because at the closing it should be 280. So you should increase that loan amount by 160 to increase to 280. Okay, now let us go to part C. An entity attendant. Okay, so same thing, everything is repeated. Here they have purchased a land at this date and he paid for the land in currency of Ryan. The purchase cost is this much, and at the reporting date, that means at the year end, statement of financial position, this is the value for the land. Okay, you have been given the, so how this land should be measured at, one is at cost, one is at fair value. Okay, let us first go through the cost. So if you see 60,000, okay, purchase cost, and value of the land at the reporting date was 80,000. So let us go by that 60,000 first. Okay, first March. So it is initially at cost. We know the asset is initially recognized. So it should be again translated functional currency using exchange rate at the purchase date. Okay, so it's 8. 60,000 divided by 60,000 is the cost. We are not taking 80,000 yet. So it will be initially recorded at this amount. Okay, remember land is not a monetary item, so it is not retranslated, not monetary. Okay, if held under the cost model, it will remain. So if it's under cost model, it will be at 7,500 only. But if the land is at fair value, okay, that valuation also has to be translated into dollar, but at the date when the fair value is determined. So it was determined on that same date only. No, I think it was, wait. No, it was determined on 31st December 2000, so different rate. Okay, so it must be revalued to 8,000. How? Because 80,000 divided by 10. 10 was the exchange rate at the date when fair value took place, and 80,000 is the fair value. So 80,000. So what is the carrying amount of the land? It must be increased by 500. Definitely, because from 60 to 80,000 value went up, there will be some increment in the value of the carrying value of the land. Okay, what is it? According to cost, it is 7,500, but fair value it is 8,000, so balance 500. It has to be increased. Okay, if the land is held under IAS 40, why they are saying under IAS 40? See, land can be used as an investment property also, as a non-current asset also in your business. Land can be used in any way. There are many uses of land. If your uses of land changes, your standard also will change. If it is for investment property, like you are holding it as an investment, then you are using IAS 40. If it is a non-current asset for you, then it is held under IAS 16. The difference you should know because the treatment for the two standards are different. You should know both. If the lend is under IAS 40, gain will be recorded in P&L. If it is under IAS 16, gain will be recorded in OCI. This is why you should know. It is held as an investment property or as a non-current asset. Okay. Now, finally, we are going to go through test understanding 3, the last one for IAS 21. Before I end this video, I highlight is an entity whose functional consists dollar. Annual report is given. So, see, in all these questions, we have noticed one thing: functional currency is already given to you. You don't have to worry about it. You just have to use the raise and convert. Okay, but in the main exam, they will give you two things. One is first you determine functional currency, then using that functional currency, you have to make your statement of financial position and profit and loss income statement. Okay, you have to translate also. First, you have to first determine the functional currency itself, then you have to translate also. Okay, using the rates. Two things you have to do, but here, this is just they wanted to show which rate to use for which one and how to present. That's why. Test understanding is not so much detail, but revision kit you must do. So they have purchased plant equipment on credit for this much on this date. He has made a payment of 180,000. Out of 400, 180 has made the payment. The balance remains outstanding, and he has he has a policy of cost accounting and depreciating plant and equipment at rate of 20%. Plant and equipment is not expected to have any residual value at the end of its useful life. Okay. So you have been given 4 rates. Real exam also, the main exam also, you will be given rates like this only, 3 or 4 dates. You need to prepare extracts from the financial statements to illustrate the impact of the above transactions. Remember, it's just extract, not the full financial statements. SBR exam will not ask you full financial statements. Okay, so that thing you need to remember. This only is extracts. So that's a good thing, right? So that's for part A. We have part B, right? We have a part B to it. But let us first finish part A before we confuse ourselves more. I don't want to confuse you also. So here, both the purchase of plant and the associated payable, even the purchase, even the payable, recorded using the rate ruling at the date of transaction. It is 10, giving the value of 40,000. Okay, because 400 divided by 10. Let me see the rate. It is 10 because at that date only, 1st of July. You have bought that plant and equipment on a credit. So that day itself, you are giving rise to property, plant and equipment as well as creditor, payable, liability. That's why both are translated using on the same date. So the part payment, remember you made a part payment, not full payment on this one. So at that date, you have to use the rate to translate. With the remaining dinner liability being restated, so whatever the remaining you have needs to be restated in dollars at the closing rate because payable is a monetary item. Okay, so the exchange difference in this case is a loss of 12,500. See calculation below. It is taken to profit and loss as an operating expense. Definitely profit and loss because they told cost accounting, cost model. Okay, is it so? Yeah, historical cost accounting. Okay. So now this table again is repeated with the dates. Don't forget to give the dates, opening the in the middle for the part payment and the closing. So you recorded payable at that rate and you have converted. One is for dinner, one is the rate, one is the dollar. Okay, then part payment you deduct, it will be deducted this rate. Then whatever is outstanding, use the closing rate and you convert. Definitely there's a difference. This is a loss because that means your payable outstanding in the year end is more than what you have actually paid. Okay, that's why it's a loss. And you need to write this also. It's a non-monetary item, plant and equipment. So it is accounted for historic cost and therefore not retranslated. Depreciation is charged. Remember depreciation charge. Okay, 40,000 into 1 over 5 into 6 over 12. It's interesting. Let us see the depreciation. It's 40,000 because this is the amount. Okay, payable recorded. That means this much you have got. This 40,000. Okay, so that 40,000 only you are taking on that 1 over 5 because 20% is the depreciation into 6 over 12, maybe for 6 months. Okay, we'll see the date. It was 1st of July 2003. So from 1st of July 31st December, right? So from July to 31st December, it's 6 months. That's why August, September, October, November, December. No. July, August, September, October, November, December. Yes, 6 months. Sometimes you can go wrong in calculating number of months. Do make sure that you calculate again. Now we are going to make extracts. That means we have to make extracts of statement of profit and loss as well as financial position. Only after those things which are impacting, okay? So one is depreciation, definitely will go 4,000. The other one is operating expenses, which is exchange loss. It will also go there. Next, in the statement of financial position, 40 minus 4,000, this depreciation are deducted from the cost, and current liability is 27,500. Okay, that is this, the payable outstanding 27. This will go in the statement of financial position. That's the closing balance. Now let us go to part B. So highlight, entered into a number of transactions with eraser. Wow, I actually like the word actually. Highlight also I have, eraser also I have. So eraser was his customer. On 1st of November 2003, Highlight made a credit sale to raise on 3 months credit. Okay, this is a 3 months credit now. Made a credit sales to eraser. So on 1st of December, this is after 1 month. Okay, Highlight made a further credit sales. So on credit, again credit. On 3 months credit for this amount increased. So by this one, they have received no payment from the eraser. Okay, as the receivables were still within their credit period, they were not regarded as being impaired. Now, so same question. This is a bit of different question. So this, some differences you will get in this question. Each of the sales invoices denominated in yen must be translated into dollar using the spot rate of the date of each transaction. Each transaction will result in recognition of revenue and trade receivable. Definitely, because we have not paid, so revenue also will be there. Even the trade receivable will be there. Okay, so for 360 it will be 7.2 at that date, and for 590 it will be at this date. So this is the amount. This is the amount. Okay, both of them are outstanding at the reporting date. That means closing, and therefore it must be restated, because receivable is monetary, so monetary assets has to be restated using the closing rate, which is 8. So exchange difference is here, it's a gain, and it will be taken in operating income, profit and loss account only. Okay, so this is how you need to write. This is the receivable recorded. This one also you translate using this rate and you get this amount, and then this is the outstanding. You add both, convert using closing rate, you get this amount. So the difference, add 50 plus 60, 110, so minus 112,500 minus 110,000, which is 2,500, is a gain, because your receivable outstanding is more than what you are supposed to have recorded receivable. So that's why it's a gain. Okay, because that means you'll be getting more from your receivable. Okay, so it's a gain. Now statement of profit and loss. So revenue, you just add 50 and 60, that 2,500 gain, and receivable 112,500 in the statement of financial position. Only receivable will go there, right? So just see that it balances. Okay, if you add this 110 with 2,500, it is to 112,500. It should add. Both should be equal to 112,500. It should balance, right? If you see for part A also, it was like that only. Okay. So now with that, we have finished test understanding also. So we have finished S21, and see you in the next standard. Until then, practice all the questions regarding IS 21. If you see on my other side, you see this is my revision kit questions which I will be doing, attempting. I'll be making, I still didn't, right? I'll be starting from 18 onwards. So we'll be seeing you soon in the next video.